Audio Jungle.
How to make 1 crore by the principles of the intelligent investor. In this video, we'll be discussing how you can pick jackpot stocks, that is stocks that yield around 30% or even more CAGR, with the principles of the intelligent investor, and discuss how we can put these returns into compounding so you could reach the target of 1 crore with as little as 1 lakh as an initial investment. So without wasting any time, let's get started. When an investor buys a stock at a price less than its intrinsic value, they are essentially purchasing it at a discount. Once the stock is trading at its intrinsic value, they should sell. Or in other words, the concept of value investing is the true king according to Mr. Ben. What does value investing mean? Value investing is more like a subcategorized term used to address investing in not only just valuable stocks, that is when EPS is great, company's debt is low, the market cap is medium large, etc., but they also have to be cheap or below their intrinsic value. There's a famous quote amongst investors that goes like, buy stocks like you buy groceries, that is cheapest and best quality. Now to add more to your knowledge, Ben Graham has already made things easier for us by giving us the formula to determine the intrinsic value of any stock. We'll just have to put the values and it'll speak up to the value of the stock in the opinion of Mr. Graham. Over here, V is the result or our true intrinsic value. EPS is earnings per share, which can be easily found using your trading app or any stock screener. And G represents the estimated future growth of the company for the next few years. In terms of percentage, this is also very easy to find. Remember, most investors don't consider the coefficient 2 along with G since it sets somewhat unrealistic expectations, which is somewhat correct, but don't worry, it would only make a minor difference. I'm not going to use it and I don't recommend you to consider it either. And other than that, Y represents the average annual returns of the highest grade or the AAA grade corporate bonds, which is around 7 to 9%. I've already mined this information for the sake of making it easier for you guys. Disclaimer, just to make sure, you should never analyze every stock purely based on this formula. The far greater thing to consider is that you should be able to understand the business model first. That is how they spend their money, how they make their money, what things they sell, etc. Once you're satisfied but need some sort of experts like Ben Graham's advice, only then should you go ahead and play with this formula. Now at this point, I'd want you to search for a stock screening tool so we could actually start listing some high value stocks first. While we're doing that, I'll go ahead and teach you how to identify an undervalued stock. I'm using tickertape.in. You find whatever suits your aesthetics. So this is what your screen would look like. On the top, you can see a thin bar showing a few popular stock tickers. More often, these are large cap stocks or the giants of the markets. You can feel free to tap on them and view their balance sheet as I did. I picked Reliance Industries Limited. You can pick any popular stock you like. Here you can see a section saying financials. Go on and give it a view. By the way, over here you can see there's a really cool function of ticker tape that estimates if the current price is above or below the intrinsic price. Though it does not estimate the exact or nearly exact intrinsic value, so we'll stick with Ben Graham's formula for now. Now right after opening the financials option, you go through their balance sheets as I did. And what do we have over here? Interesting. Over here you can see a 40% increment in the revenue from last year. But take a look at the net income. It has taken a small dent. Though Mr. Ben does not recommend choosing such stocks, for now, a minor change doesn't matter. So we'll ignore it for now. Then go on and look out for the market cap of the company. It should be around or greater than 700 to 800 crore. In this case, the market cap is 17 trillion. So let's put a tick on that as well. Earnings per share should be greater than 3%. Put a tick on that as well. Debt to equity ratio should be less than the average. Ticker tape also helps with that. You don't have to worry about searching their total debt and then do the maths with it. Just go back to the financial section and you find it somewhere on the screen. Refer to the screenshot. So debt to equity ratio is also good. So let's put a tick on that as well. So until now, Reliance Industries has passed all the checks and restrictions necessary to be categorized as a valuable stock according to Ben Graham. Now, the next step is the most crucial and will decide whether the stock is worth our time or not. Here's the formula once again. Now let's add some values to it. EPS is 89.75 rupees. Average growth of EPS over the last 5-6 years is 14.17%. Y is 8.5%. It fluctuates between 7 to 10%, so 8.5 seems like a fairly safe option. Putting in the values, we get V is equal to 1051. Even if we make room for miscalculations of 10%, the intrinsic value turns out to be 1150, which turns out to be the true intrinsic value of the Reliance stock. At the moment, it is trading at well over 2,500, which means that it is quite overpriced and not a great yielding stock for the moment. You can try the same with other stocks as well. Try out for yourself and see if you could get a jackpot on your hands as well or not. I've picked a few more stocks. Let's have a final look at this topic before we move to how this 30% CAGR will make over 1 crore over time. Number 1 is Happy Minds Technologies, currently trading at 1051. The company belongs to the IT sector. EPS stands at 135 rupees. The growth rate is found to be 13.4% and Y is considered 8. Then putting these values in the calculator, we get 1530, almost 50% undervalued. Even if we pull out 5 to 10% for miscalculations, which does not likely happen, we would still walk away with nearly 30-40% profit over time. Number 2 is Kaplan Laboratories. This company belongs to the medical sector. EPS stands at 30 to 31 rupees, growth rate is 24% and Y is the same, 8%. Doing the maths and the intrinsic value is found to be 932 rupees when the stock is currently trading at 774 rupees. So these were some stocks that I found to be undervalued and would easily yield a good profit over the course of the next 10 to 15 years. Now let's be quick and get these stocks to work so we could actually see the magic of compound happen. For that reason, open up any compounding calculator from the internet. Initially, as you can see, there are 4 major factors directly affecting your trajectory. Let's have some fun with this first and then see which one of them plays the most important role to help you make your first crore. First is the initial deposits you'll dump into the market. The most important thing to remember is that this money should not be a part of your bread and butter, only the money you own and access, as if it would be sitting in the bank anyway. Or in other words, your life would not be bothered without it. I've considered 1 lakh. You can start with as low as 50,000, but at least 50,000 should be a minimum amount since we don't want to stretch our target to 30-35 years, plus a 20% annual return, which is a pretty nominal return. Multi-cap or flexi-cap fund could guarantee these, or 30 to 40% if you give Mr. Ben Graham's technique a try. The second and most crucial factor, at least in my opinion, which greatly accelerates the compounding process from growing like a sloth trying to climb to growing exponentially, is your initial monthly contribution to the investments, which will greatly impact the results. What happens is that when you're starting with 50,000, 60,000, 70,000, 20 to 30% returns will take almost 5 to 6 years itself to get you into the 10 to 20 lakh league. This is where your monthly savings of 5,000, 6,000, 7,000 brings a considerable boost. You'll see how 1.1 crore from the last case where we weren't saving monthly cash for the stock market versus 3.1 crore if you merely invest 5,000 each month from the start. Plus, if you do your math right, the same target of 1 crore can be reached within much less time than it would take you with just 1 lakh in the beginning. As for the estimated time span, ideally 15 to 25 years is the norm. The longer we wait, the more exponential growth you'll see on your undervalued stocks. Only sell them if the same formula tells you that your stocks are overvalued. Never sell them at an undervalued price. Hold it tight and forget until the price recovers. And the return on investment. You've already done and dusted this one. If you're still feeling you're missing out on something, then go ahead and watch my How Beginners Can Invest into the Stock Market video to clear any misconceptions. So what did we learn? You see, compounding is by far the most fruitful method of investing out there, and it only works best if you leave it uninterrupted. Plus, the only thing most of us would agree with is that compounding takes a lot of time to speed up and actually start taking developing the pace we are looking for. You would easily not see the face of your 1 lakh rupees plus the savings for the next 10 to 15 years. It's just like planting a seed and taking care of it till the point it grows to start giving fruits. Now, none of us are Akshay Kumar, who had doubled his wealth within 25 days. Remember Hera Fairy? But what you can do is make efforts on your side and leave the educating part over to my channel. This is Omega Finance signing out.